Today, we will talk about discounted cash flow, DCF. Discounted cash flow refers to a valuation method that estimates the value of an investment using its expected future cash flows. DCF analysis attempts to determine the value of an investment today, based on projections of how much money that investment will generate in the future. It can help those considering whether to acquire a company or buy securities, and also assist business owners and managers in making capital budgeting or operating expenditures decisions. The purpose of DCF analysis is to estimate the money an investor would receive from an investment, adjusted for the time value of money. The time value of money assumes that $1 that you have today is worth more than $1 that you receive tomorrow because it can be invested. For example, assuming a 5% annual interest rate, if a $1 payment is delayed for a year, its present value is 95 cents because you cannot transfer it to your savings account to earn interest. DCF analysis finds the present value of expected future cash flows using a discount rate. If the DCF value calculated is higher than the current cost of the investment, the opportunity should be considered. If the calculated value is lower than the cost, then it may not be a good opportunity. To conduct a DCF analysis, an investor must make estimates about future cash flows and the ending value of the investment, equipment, or other assets, and determine an appropriate discount rate for the DCF model, which will vary depending on the project or investment under consideration. The formula for DCF is DCF equals $1 plus CF_2 / 1 plus R, $2 plus CF_N / 1 plus R, $N, where CF_1 is the cash flow for year 1, CF_2 is the cash flow for year 2, CF_N is the cash flow for additional years, and R is the discount rate. When a company analyzes whether it should invest in a certain project or purchase new equipment, it usually uses its weighted average cost of capital as the discount rate to evaluate the DCF. The WACC incorporates the average rate of return that shareholders in the firm are expecting for the given year. For example, say that your company wants to launch a project with a WACC of 5%. That means that you will use 5% as your discount rate. The initial investment is $11 million, and the project will last for 5 years, with the following estimated cash flows per year. Here are 5 key takeaways. 1. Discounted cash flow analysis helps to determine the value of an investment based on its future cash flows. 2. The present value of expected future cash flows is arrived at by using a projected discount rate. 3. If the DCF is higher than the current cost of the investment, the opportunity could result in positive returns and may be worthwhile. 4. Companies typically use the weighted average cost of capital, WACC, for the discount rate because it accounts for the rate of return expected by shareholders. 5. A disadvantage of DCF is its reliance on estimations of future cash flows, which could prove inaccurate. Hope this would help. Thanks for watching.